Welcome to This Is Money podcast, sponsored by Charles Stanley Direct. I'm Georgie Frost, and joining me and Lee Boyce today is Helen Crane. And coming up, the government's announced a cap on ground rent, a welcome policy that finally fixes a broken system, or does it risk creating new problems along the way? Watch out, HMRC is about. Stamp duty investigations are on the rise. Is it all Angela Rayner's fault? Also today, despite a bit of a tumble this week, gold and silver have been on a tear up of late. Is it a sign of bad things to come? NS&I has made some cheeky cuts to its bonds, but cash ISA season is upon us and the rate battle is on. Plus wood burners. They're going cheap at the moment, but can you use them without destroying the planet? Don't forget to stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. But first, a message from our sponsors. We know you love staying informed about money, therefore we think you'll love this. Charles Stanley Direct's financial coaching service gives you one-to-one time with a qualified expert, helping you make sense of your finances and feel confident about your next steps. Book a free 15-minute call today at charles-stanley.co.uk/financial coaching. That's charles-stanley.co.uk/financial coaching. Remember, investment involves risk. Now back to the show. Labour's announced plans to cap ground rents for leaseholders in England and Wales at £250 a year from 2028, with a promise to phase them down to almost zero eventually. It's welcome news for the over 80% of leaseholders who have to pay the charge. But many say ground rent is only a small part of the problem, with service charges, cladding costs, and lack of control leaving flats hard to sell and sometimes effectively worthless. But a move to fix a broken system could have unintended consequences for pension funds. Helen, a lot in this story. Let's just go back to basics. Ground rents. What are they? Who has to pay them? They're different to service charges, aren't they?
They are. I think the first thing to say is, on the face of it, this sort of sounds like it might be quite a small story, but it actually isn't. As you said, there's so many different elements to this, and it really has sort of brought the whole leasehold problem into focus again this week, I think, and all the difficulties of fixing that. And, you know, there are about 5 million leaseholders in the UK as well, so it's not a small amount of people that this affects. It's essentially anyone who owns a flat and some people who own houses as well. So ground rents are a charge that people pay normally annually, that leaseholders pay to their freeholder, which is, to put it simplistically, the company or person that owns the land that their flat, we'll say flat because most of them are flats, the land that their flat is built on, and they own the building as well. So if you've got a block of flats, you own your own flat, your own individual unit, but what the freeholder owns is first the land and also the wider buildings. So like the communal areas, like your hallways and your gardens. The freeholder is the person that owns those. And you kind of need a freeholder because someone does need to own that wider building. But ground rent's really controversial. So they're essentially paid for the right to live, the right to have your flat on that freeholder's land. So people kind of call it feudal and a bit medieval. It's essentially paying your way so that you can live in your flat that you own on this landowner's property.
And how much are you talking here?
So it really varies. So the cap that's been brought in, this was announced by Keir Starmer this week, is £250 a year. And for some leaseholders, that will be around what they pay. So the average, and this is from 2023, the last time this government data was taken, so people might be paying a bit more now. The average across the UK is £304. In London, I think it's just over £400. However, some people pay much, much more because there's these really sort of egregious clauses in some leasehold contracts that say that the longer that you stay in your flat, the ground rent kind of continues to go up. So something might have a clause that says the ground rent doubles every 10 years. And that's when it can get really, really tricky and people can kind of get trapped with these big charges. So one of my colleagues spoke to someone this week who said that their ground rent was now over £1,000 a year because it had started at something like £250, then it doubled after 10 years, and after another 10 years it went up to £1,000. And when you get into those sort of levels, it starts to make flats maybe difficult to sell because someone else doesn't want to take on a flat that has, this £1,000 charge every year, and then also on top flat owners, if you live in a big block, normally pay quite chunky service charges. So it's a part of a much bigger sort of headache, I guess, that leasehold property owners have. So I think people will welcome this. We should say that this 250 cap that Labour has proposed, this is just in some draft legislation that's been put forward. So it's not law yet. People are still paying these charges now. And the earliest it will come into force looks like 2028. So, and you know, that's if it does happen. Some people have pointed out that that's obviously quite close to the next election. So whether it will happen sort of remains to be seen. But it is good news. But you know, as we said, leasehold is part of a much sort of bigger problem.
Lee, you were nodding along during that. I was just ever so slightly distracted because Helen spoke about the Prime Minister announcing it, and it was on TikTok, which unsurprisingly I missed.
Yeah, me too. Not the target audience, obviously, Georgie, for this announcement. But that's the way the world's going. New media, things getting announced on the cool kids channels, getting down with the kids, telling them about the ground rent. Before I wade into this, I used to work for a company before I was a journalist when I was at university doing a summer job, and my job was to basically do credit control and phone up people who'd missed their ground rent on certain properties. And I can't name names, but one time I had to phone a very big name celebrity. Also came up on, if you've ever worked in a call center, you know what I mean. It just all also appeared, and I was like, I had no time to prepare to phone this celebrity and say your ground rent was due and the invoice had been missed. The person actually answered the phone. I think that I think leasehold ground rents, service charges are an incredible racket. On the whole, I think that they are littered with unfair clauses in which they might go up with inflation, they might be doubled, they might triple. There's a lot of unfair clauses in these things. And Helen was talking there about flats, and this does affect a huge amount of flats. But there's also been there was an uptick, I would say, in the kind of mid 2010s of lots of new build estates with houses on that have also fallen into this kind of leasehold ground rent trap, service charge trap. And you would have been told about it. It's not like a mis-selling scandal. Like when you buy a house, we know the process is incredibly slow because there's so many searches and so much information that we have to digest. So it's not like people have gone into these things blindly, but what quite often happens, especially in terms of a flat, quite often it's a first time buyer property, and you're a bit of a novice at buying a property and might see things like ground rents and leasehold and just really not wrap your head around it and kind of know what that means. And it's I would say it's a uniquely British thing, really. I don't think this is a kind of a global system that's used in many other countries. Leasehold ground rents, it does feel pretty medieval. So I feel that anything that's happening to get this under control is a good thing. It's just, as Helen pointed out there, 2028 feels quite a way away. There's going to be legal challenges from, people with vested interests in this who make money from these fees. And it's scratching the surface, really, Georgie, in terms of the real problems with leasehold and service charges. I mean, we've had some examples of service charges that it would make your eyes water, the amount of money that people are being charged. And trying to get a breakdown of where a service charge goes and who's being, used, which companies are being used to do certain things for service charges is incredibly difficult. And people feel like they're blindly handing this money over, and getting very little in return, and it's just getting more and more expensive. So it's quite a big problem. It's a big thing to tackle, and whether they can actually make this happen or not is another thing. And it's £250 a cap when people are paying an average of 300 and something. that great.
Yeah.
I mean,
Yeah.
yeah, I don't know. I mean,
I mean, it stops the spiraling, like you said, Lee.
it
And I
stops
think,
the spiraling. Yeah, it does. It does have that effect, but it doesn't stop other aspects of the costs involved spiraling though. And that's what
yeah,
I guess that's what the worry would be. Well, we'll just dump this into the service charge part instead. You know, that's maybe why they're talking about this coming in 2 years' time, because there's a lot of kinks to iron out, and there's a lot of. I don't think this is a one size fits all kind of problem. And I think it's more expensive in London and the southeast compared to up north. What I'm trying to say here is if you're paying £100 up north somewhere and it's £400 in London, and it's the same property owner, because a lot of pockets of land have been bought up by certain companies and whatnot, they'll just pull levers to try and smooth this all out and make sure their bottom line isn't being hit. So on the face of it, it seems like a small story, and it seems like a very sort of straightforward, here's a cap coming in. But there's a lot of complexities, I would say, in this that are going to need to be addressed, and it's going to take time.
well, there's two issues. There's one that was a bit surprising, Helen, which I mentioned very briefly about pension funds and the unintended consequences there. But just the other part of it was the fact that we've spoken about this on the show in recent months about the problem with selling flats. And this to me doesn't seem like it's, as I mentioned a little bit earlier, going to really make a difference. I mean, this is something that you've written about, something that you're invested in. So what was your conclusion?
I think this ground rent news it's part of a much bigger range of things that are happening to leasehold to hopefully make this better. It's really sort of fragmented. So there's loads of different little bits of legislation. There are different sort of parts in the legal process. There was actually a Leasehold Reform Act that was passed, I think last year, or was it the end of 2024? But it hasn't been implemented yet because the freeholders who own these properties keep bringing legal challenges. So it's really, really fraught with difficulty. I think we are on the way to making things better, and I think that's right. But it's a sort of situation where there's so many vested interest that it takes a really long time. I mean, the government's sort of grand overarching plan eventually is for all new flats to be common hold instead of leasehold. Common hold is something that is common in other countries, but we haven't. It's not really used in the UK, and it's basically a system where if you had a bunch of flat owners in a block, they'd essentially all own the building jointly. It is similar to share of freehold, which some flats are owned under now, but it gives them a lot more sort of control over what happens. It does mean that they have more kind of management responsibilities, though, so it can be a bit of a sort of double-edged sword. I think things are changing, but I can totally understand why leaseholders are frustrated at the pace of that, especially when, as Lee said, these are people's starter homes. Some people do, but people don't often buy, a one-bed flat in a city centre and think, right, this is my home for life. These are people who sort of getting on the property ladder. And then, we spoke to someone this week who had bought his flat in 2016. He's now married, really wants to move out, but they're still living in this one-bed flat because it has unsafe cladding, which is another issue that leaseholders face. So they can't sell it, can't move out, and people just kind of get stuck in their starter homes and can't move on because all their money's tied up in it as well. It's not like, they can rent it out and move, because that lump of cash that they would need to move somewhere is all tied up in that house. So it's extremely difficult. There's loads of different issues with flats, and especially new build flats. But hopefully, at some point, it'll start to get better. But as I said, I totally understand why people are frustrated.
Yeah, it was when I was looking for a place to buy, that was my absolute no way would I get something like that. Anyway, I want to talk about something that investment manager M&G said. So basically, the government plans to cap ground rents are disproportionate and risk ruining the UK's reputation. And then we've got the pension funds bit. What is this about?
M&G are one of the vested interests that Helen and I have kind of brought up here. So it's directly exposed to £722 million of ground rent assets. And it says if the changes are approved, it would lead to a one-off £230 million reduction in the group Solvency II own funds and reduce its solvency by 1 percentage point. So put that into plain English, please, Lee. Chat
Thank you.
GP Lee. It's essentially saying that obviously some of the ground rents that it charges are over this £250 benchmark, so it's going to reduce the amount that they're making. People may not realize this, but they might have M&G in their part of their pension plan. They might not, you might not even know, it's that kind of like breaking it down and going and have a look what you're actually directly exposed to. And it said it supports plans to strengthen leaseholder protection and tackle the ground rents, but the proposed solution is disproportionate, and we will continue to consider our response, which goes back to the point that Helen was making. This is just one company that's saying this. There's going to be a variety of companies that are going to be, frantically preparing their statements, getting lawyers, working out how to circumnavigate this. And it says you have to write down the value of some of its assets and expects a £15 million hit to annual profits. And I look at that and I think £15 million hit to annual profits. It's hard to explain, but it's like these companies are obviously making quite a lot of money out of this activity, and indirectly,
Which might surprise people.
yeah, they might, and indirectly, you might be exposed to it in your pension fund. I mean, you might be someone that's paying ground rent to a company, and you're also invested in that same company in your pension. So it's almost like you're paying your own pension with your ground rent. But there'll be a lot of this, Georgie. I would suspect in the coming weeks and months, as these companies kind of explain their, direct kind of hit, what the hit they will take from this. And I would expect a battle, because no company wants to be shaving off anything off their annual profits. But I think, I honestly, in my own personal opinion, I'm not affected by this at all. But I've always thought that ground rents and service charges are incredibly unfair, especially when they start spiraling out of control. And it's good that it's on the forefront of, hopefully being shaken up and made fairer.
All right, then, let's move this to one side. Correlation does not imply causation and all that. However, since Angela Rayner was caught not paying the correct amount of tax on her seaside apartment in Hove, HMRC has carried out more stamp duty investigations. She had to resign as Deputy Prime Minister and Housing Secretary, if you remember, back in September, after it was found she broke the ministerial code. Now, according to new research, stamp duty land tax investigations rose 88% in the 2024-25 tax year, up from the previous year. So just remind us briefly what happened and why this might be linked.
Yeah, so the Angela Rayner issue, it seems like a really long time ago now, doesn't it? Back in September 2021. So many things have happened since then. But essentially, it was this issue around stamp duty and pretending that a home that isn't your main home actually is your main home for stamp duty purposes. So if you buy a property and you're not going to live in it as your main house, so either you're going to rent it out or it's maybe a holiday home, as I think it was in Angela Rayner's case, you have to pay more stamp duty. So now there used to be a 3% stamp duty surcharge for second homes. It's now recently gone up to 5%. So it's a chunky extra amount of tax you have to pay. But obviously people try and get around this in all kinds of different ways, claiming that the place that they actually live is not the place that they actually live. And there's some rules around kind of how something is defined as being your main home or not. And I think this is where Angela Rayner kind of got into a bit of a sticky situation. So HMRC will look at it on a kind of case-by-case basis, and they'll look at all kinds of different things, like where do you spend time? If you have kids, where do your kids go to school? Where do you work in relation to where the property is? Or to kind of make an educated guess on whether that actually counts as your main home or not. And I think people are kind of trying to bluff this now. I mean, I don't know if anyone's been sort of inspired by Angela Rayner to try and do it. Obviously, she got caught out, but she's a very high profile person, so kind of all eyes were on her. But it seems like there's people all over the country who are kind of trying to play this game as well and say, oh no, this is a main home. I'm not going to rent this out. This isn't just my holiday home. This is where I live. I don't owe this extra stamp duty surcharge. So yeah, it's something HMRC are looking into more and more, and trying to crack down on that thing by the sounds of it.
Lee, where are they getting their information from? What sort of things might you be caught out on?
Yeah, they look at all kinds of different things. So if we sort of cast our minds back, in Angela Rayner's case, her other property was owned it'd been put into a trust and was owned, if I remember rightly, by someone else in her family, sort of through that trust. And I think that was part of the reason why she thought that either she was in the right or that she could get away with it, depending on your kind of view on that, I suppose. So that actually doesn't kind of hold much weight, though. So in our article, we spoke to a tax expert, and he said whether a property has been transferred into a trust or to a partner doesn't necessarily carry much weight with HMRC. So they essentially, HMRC are kind of going snooping a bit on this, really. So first of all, they might kind of talk to your solicitor or your conveyancer who acted on your behalf when you bought the property. And they'll check your tax return for accuracy. They'll write or phone you to tell you if they want to check your stamp duty return. So they're essentially looking at all kinds of sources, the land registry as well. Professional advisor, accountants, lawyers, financial advisors could all shop you to HMRC. Technically, they're obliged in a sense to do that under sort of financial regulations if they think that something's not as it should be. And it also has, and I didn't know about this before we did this piece this week, a sophisticated AI system called HMRC Connect, which essentially gives access to vast amounts of personal and financial data on people.
Goodness.
It's actually used this since 2010 to identify potential cases of tax evasion and avoidance. HMRC has a AI sort of supercomputer, which cross-references all kinds of tax records with other databases. So like the land registry, maybe bank accounts, overseas bank accounts, and also, of course, gets anonymous tip-offs from people. So if you've annoyed one of your neighbors or something and they suspect that you're not living in your house full time, then do be aware that they could shop you to HMRC.
Goodness me, all of those AI and computers and all that, and they still can't answer the blooming phone.
I was
Lee,
going to say, hey, HMRC and sophisticated AI software catching out people for stamp duty makes you just go, is this real, or is this a kind of like, line they put out there to try and scare people? A bit like when people don't pay for a TV license and they threaten to kind of like find out if you're using the TV or not. It feels a little bit like that. But I guess, their strategy is working, Georgie, whatever they're doing, because, as you pointed out right at the beginning there, the investigations are up 88%, 3,035 in the most recent tax year, up from 1,617 the previous year. And the additional tax recovered is up 135%, so to £200 million, up from £85 million. So obviously a lot of people are trying to dodge the system and think they're going to get away with it, and they're not. Is the long and short of it. And most of us, the large majority of us, always want to make sure that we're doing the right things and not falling foul of HMRC or doing things that are a little bit dodge. And I'm sure some of this is honest mistakes, because again, things are complicated when it comes to tax affairs, and people are making mistakes. Look at Angela Rayner. I mean, I don't think she would have purposely wanted to have dodged that, and that whole kind of massive news story that came out about it. So if she's getting caught out, you can imagine quite a lot of other people are getting caught out because they're getting confused by the rules. But again, it's really where a solicitor should be doing the legwork and telling you how much your stamp duty bill is, because having just filled out one of these forms, it does very clearly ask you at the mountain of forms, but it definitely asks you if you own any properties, whether this is going to be your main residence. There's a lot of boxes to tick that I feel would catch this. So it must just be people thinking they're going to get away with it, is how it seems to me.
that's it for part one.
I'm joined now by Rob Morgan from Charles Stanley Direct for our weekly Investing Explained feature. Rob, we've got a question from a reader this week. I have multiple accounts across several platforms and I'd like to consolidate to one platform provider. What benefits does this bring and what considerations should I have?
So it's a good question. Consolidation can make sense. For example, to keep everything under one roof with one provider can really help with monitoring your investments and keeping to an investment strategy across multiple holdings. But before initiating any transfer, make sure you're aware of any drawbacks that are involved. These include any exit charges and the fact that if you don't transfer as stock, whereby you preserve your holdings and you transfer in cash, you'll be out of the market for a period before you buy investments with the new provider, and that can either work for or against you depending on what markets do. However, bearing all that in mind, it can be worth consolidating to optimize the balance of account features and benefits you have, as well as the service you get and the charging structure that you're happy with. There are multiple ways platforms charge, and by consolidating, you can potentially save money through a larger account size, although it depends on the circumstances and the provider involved. For instance, many platforms charge on a per account basis, so ISA, SIP and investment account are each charged separately. But with Charles Stanley Direct, there is a fee cap applied across all a person's accounts combined, which can potentially save money. And with Charles Stanley Direct, there's no separation between fund charges and share charges. All investments do come under the same percentage-based charging structure that never exceeds the £600 annual maximum charge. There's also £100 worth of trades each year included in that deal. Transferring can also unlock different features for your accounts. So the range of investments, for instance, Charles Stanley Direct offers a flexible stocks and shares ISA, which is actually quite a rare feature. A flexible ISA allows you to withdraw from your ISA and subsequently replace the money without affecting your annual ISA allowances. You just have to make sure you do that before the end of the tax year. So while investing involves risk and is therefore for the longer term, that could be a valuable feature to access funds on a temporary basis and replace them without losing ISA allowances built up over the years. Finally, there can be particular opportunities for offers of cashback on transfers that can be maximised with larger amounts. For example, with Charles Stanley Direct, there is currently an offer of up to £1,500 for transferring eligible accounts across. But as always, with any offers like this, terms apply, so do always check those carefully.
Rob, thank you very much.
Thank you, Helen.
Welcome back. Gold has been on sparkling form of late, despite a little tumble this week. The precious metal is still up around 17% so far this year at the time of recording, obviously. Silver hit new highs and even copper started to pick up. The moves are being driven by mounting geopolitical tensions, with precious metals seen as a haven in tumultuous markets and tumultuous times. So where will it all head? And what does it all mean? Lee, what's been going on with gold? I just want to sing Spandau Ballet, but I can't sing, so I won't. And the little tumble that it experienced. But just let's talk about the tear up that it's been on.
I once sung gold karaoke night at a student bar at university, and I destroyed the microphone. It was quite expensive because I was screaming gold so loud down the microphone. Nice little story for you there. Yeah, this podcast is always delivering, isn't it? It's always giving something, a little insight into life. Yeah, ruined the microphone.
Maybe at the end you could give it a go.
Yeah, I don't want to ruin this microphone.
All right,
mate, so I better not. Gold and silver, metal madness, Georgie, I think is how it's been coined this week. And you only have
Coined.
Here we go. You look at the price chart of both gold and silver, it's absolutely incredible. Price of gold is up 83% in the past year, from 2,300 an ounce to gone past $5,000 this week. It went up as high as 5,600, but as you say, at time of recording this podcast, because who knows what's going to happen next. It's back down to sort of 5,100. Silver's on an even bigger tear up. From a much lower price point, we've seen year-on-year change of 224%. If you bought silver a year ago, 18 months ago, you'd be sitting quite pretty now. The price of silver is just absolutely astronomical. So there's a number of things that are going on. Geopolitical factors are definitely, the main one to mention here, because people see it as a safe haven. They turn to it as a safe haven in times of kind of worrying situations across the world. Only this week, the tensions between the US and Iran is an example of that. Got the whole Greenland situation still rumbling on in the background. We had the trade tariffs. A lot of it driven obviously by the US. A lot of things that I mentioned here driven by the US. There's pressure on the dollar at the moment, and part of this is also driven by a kind of global worry about potentially the US president stripping away the independence of the Federal Reserve. That's part of the picture. Concerns over debt, inflation, monetary policy. Again,
There's a lot going on, isn't there, Lee?
largely in the US. Silver specifically is a kind of slightly different beast, because a lot of the demand there's demand from sort of AI infrastructure, data centers, solar, green energy technology, things like that, where silver is actually used. And people have kind of really speculated and got in there, and it's just driving prices up, absolutely phenomenally. It really has been metal madness. It's just been insane. But you mix all of those things together, investors are always looking for a diverse portfolio and to get involved in things that potentially might hedge risks elsewhere. And it feels like a lot of people have turned to precious metals as a way of kind of doing this. And as I say,
Safety, is that what you're saying, Lee? A bit of a safe haven.
Safety. It's a safe haven product. There's also that part that the other part of the puzzle of this a little bit as well is, I think that let's just kind of drive towards having a physical asset. You might buy a gold coin or a silver coin or a gold bar, a silver bar, and actually hold that asset in your hand and see it in a world in which a lot of things we do are on a screen. You don't actually physically kind of see these things. But I'm just looking at this gold chart here, Georgia. I mean, it's absolutely phenomenal. It was flat for so long. You look at a 10-year chart, flat as a pancake, and then you get to sort of 2024, and it just starts to completely take off. Now, where it goes next, of course, is what a big question will be for investors. That does it come to an end? A lot of analysts, though, are still bullish on where precious metal prices are going to go this year. Some suggesting it could reach 6,000. Gold, this is, could reach $6,000 an ounce. Deutsche Bank said heightened tensions and higher defense spending create a long-term case for gold. RBC says bullion could push as high as $7,100 this year if last year's rally continues at a similar pace. But Neil Wilson at Saxo UK, he's an investor strategist. He warns that the recent precious metals run has all the hallmarks of a speculative squeeze. This is increasingly disorderly, volatile, and dangerous. And he goes on to add, we know the backdrop and solid fundamentals to this trade, but the moves are highly unusual. The volatility can be self-sustaining as market makers become reluctant to take and hold positions, leading to thinner liquidity and greater volatility. So,
Right.
it's very, very difficult, obviously, to predict what goes on next. But a lot of the analysts are very bullish still. Is the kind of general vibe. And
So if you think you're buying in, tread with caution.
exactly, yeah, and think about what percentage of your investment portfolio this is making up, or you don't even have to think about it in an investment point of view, more your overall wealth in terms of where your money is in pensions, savings, investments, how much volatility you really want to have. It's almost like a FOMO of cryptocurrency, though, because it's so accessible to be able to get your hands on. One thing is for sure, though, if you have got some gold or silver rattling around in jewelry boxes and wherever else you might have your jewelry rattling around and you don't wear it, you're going to get a good price for it now.
Can I ask Lee a really stupid question? I think this is going to out me as being an incredibly stupid person. But so they're saying copper is going up now, which seems insane. Copper is now a metal that people want to buy. I have tons and tons and tons of like 1p's and 2p's. I have those giant bottles that they use in pub, like spirit bottles in pubs, like the upside down ones. I have one of those absolutely full of like 2p's. A, are they actually made of copper? And B, is that now worth more than the value of the 1 and 2p's? Is that an insane question?
I know the answer to this. Well, I know that aren't they copper-plated steel? So they're mostly steel, aren't they?
Oh,
But I mean,
thought-
unless you scrape off the copper of them.
It all depends, Helen, because in 1992 they changed the makeup of a 2p coin. So before September 1992, it is approximately 97% copper. But Georgie is right. Post 1992, coins minted are 2p coins minted are copper plated still. So it's roughly 7% copper. So
okay.
sorry, mate. But it's a good question. Do you know what? We're going to answer that next week on the website because I reckon people will read that.
Okay, I'll check if there's got any pre-1992 models in there.
Yeah, and it is a good question related to copper and copper's movement because it does have a bit of a nickname among investors as Dr. Copper for its reputation that it can predict economic trends. So there you go. I don't know where you would take those coins to get loads of money from, but anyway. Right, savings, Lee. I can just feel the red from your face coming as you get excited about Cash ISA season. But before we do that, rein it in because we need to talk about NS&I. Cheekily cutting, you said, Helen, rates on 2 of its easy access accounts, just as your savings expert Sylvia Morris predicted. So let's go there first before we start talking about Cash ISA's inching rates up. Helen, what's been going on with NS&I?
So it has unfortunately cut the rates on 2 of its popular easy access accounts this week. So these accounts are income bonds, which are popular with some 222,000 pensioners because they pay out interest monthly rather than annually. So the rate on those used to be 3.26% and is now going to fall to 3.01%. The direct saver, which is the annual sort of equivalent of that account, is going down from 3.3% to 3.05%. And that's going to hit 430,000 savers. So that's quite a significant chunk of people. Yeah, it is quite a large cut, way below the base rate, which is now at 3.75%. So I think, that takes these NS&I accounts, significantly below some of the other comparable ones on the market. So I think a bit of a sort of disappointing one for savers. And this comes as well if you look at comparable accounts. So, for example, Cash ISAs, we're seeing a little bit of a sort of rate rally as sort of ISA season comes around. So, making it NS&I, I guess, less competitive compared to other accounts that people might be looking at.
So a bit disappointing, Lee Boyce, but bucking the trend of Bank of England cuts, we are seeing some Cash ISA providers inching their rates up. So the question is, where should you be parking your money? How do you find the best account? And what has been going on in the Cash ISA market, Lee?
Just quickly on the NS&I one as well, I think that they've sacrificed a couple of those accounts to keep propping up the premium bond prize rate because premium bonds really are, people are still pouring in a lot of money into premium bonds, and they've kept the underlying rate at 3.6%, which I think is a bit of a surprise that it's still holding up. And it probably is next for the chopping block, but it just feels like this has like been a bit of a sacrifice to keep that. But yeah, we are slowly moving into ISA season, Georgie, aren't we? And of course, we've had all of the excitement over the reduction in the Cash ISA limit from April 2027 for under 65s. But yes, there has been a small little skirmish, I would say, from some of the kind of smaller providers. Well, I say smaller providers, kind of lesser known names, I would argue, compared to sort of big banks, and whether it's a home for your cash that you're up for sort of going for will just depend. So eToro has got a 4.49% rate, comes with a 0.8% boost for 12 months, minimum deposit of £500, and if you're transfer it in, you have to have a minimum of 15,000. Trading 212, 4.38% with a 0.78% boost for the year. Minimum deposit of £1, and you can transfer in, but the boosted rate only applies to current tax year subscriptions. Complicated stuff, this, George. It's not as simple as here's your ISA rate. Money box 4.39%, a 0.94% boost for 12 months. £500 minimum deposit, accepts transfers in. And finally, in this little cohort of rates that have been going up, is Plum at 4.36%. Really chunky bonus, though, of 1.82% for 12 months. So that's going to fall very, very harshly. £1 minimum deposit, and crucially, it accepts transfers in, but the funds won't receive the boosted rate. So probably not going to be a home for your transferred cash ISA. Now, as I said, I've just listed out some names there that you might not be familiar with. And if you have a look through our cash ISA tables, there's Atom. Again, you might not have heard of these. These are all FSCS protected, by the way, which is the financial services.
You wouldn't mention on your website, would you, ones that
No.
are not, right?
You know, but you do have to be a little bit careful at how these guys split the money, depending on who you're choosing, because they might split it between banks that you already are a customer of, and if you are fortunate enough to have, you know, big bundles of cash, you want to make sure that you're not going over these limits. So that is an important point. But you have a look at these. In fact, all of our savings tables, they're just dominated by smaller names. So I'm looking down the list here. So we've got Trading 212, Plum, Moneybox, Atom, Vida Savings, Synergy Bank, Charter Savings Bank, Vanquis Bank, Vida Savings again, Family Building Society, Kent Reliance, Aldermore, Tandem Bank, Leeds Building Society. Leeds Building Society, obviously a fairly big brand, and Skipton as well. You got Virgin Money in there, 3.9%, and then it just all starts to really collapse from under that point. So yes, there's a little cash ISA battle, but it's all from kind of platforms that you should go and research, make sure you're going to be happy with it, make sure the customer service has got good reviews. But as I said, we wouldn't mention these rates if we hadn't done the due diligence on them.
What do you think will happen, though, going forward with cash ISA rates, just for the next tax year? Because obviously the changes and all that coming in, what do you think will be likely?
I think that it could go down two routes. I remember when we were talking about this last year, when we were there were rumours about it being cut, and I said this might be the last chance to cash stuff your ISA, and it could shift behaviour where people might ordinarily split between a stocks and shares ISA and a cash ISA. They might just all put it into cash because it might be the last chance to be able to do that. I think that's probably again what might happen this time round. So it's either going to be that there's going to be a battle from providers to get really good cash ISA rates out there because they know the appetite will be there. But you could look at it from the other point of view and go, well, people are going to be looking for homes for their cash, and providers are going to max out pretty rapidly in the cash ISA front, targets. So I know it's going to be interesting. Hopefully there'll be a bit of a cash ISA war. And if there is, it will be led by all of these types of provider. It won't be the big banks or the big building societies. I very much doubt anyway.
Thank you, Lee. And finally, wood burners have a bit of a PR problem. Very beautiful. They feel great. A bit get in your throat a little bit, maybe. But can you use them, Helen, without upsetting Ed Miliband? Basically, is the question. You have a reporter that's gone out, investigated. They reckon, yeah, you probably can. What's this about?
Yeah, this is a great piece, actually. So it's by our reporter, Toby Warren, who has a wood burner. And I think people are just maybe tending to avoid them now because, as you said, they have a bit of a PR problem. There's loads of different rules about how you can use them and what you can burn. And I think people just think, oh, do you know what? I can't be bothered. I just turn the heating on rather than get a wood burner and have to work out what I'm allowed to do with it and, have to find specific things to burn and have to be in control of how much smoke it emits and, potentially have people who come around judging me for burning the planet. I just won't bother. But this is the reason why this is such an interesting piece is because Toby has explained how he uses his and the fact that actually, it doesn't have to be as bad for the environment as people think. It's not great. It's not like planting a tree, but it actually can be much more eco-friendly than people maybe think. And actually, wood burners are going quite cheap now. And so in this article, Toby spoke to someone who, in fairness, works for a wood burner company. But he said that campaigns and, as you said, Ed Miliband's sort of drive against people using wood burners has sort of brought the prices down. So he said during COVID, people loved wood burners and they were sort of flying off the shelves, prices were going up. But now they've fallen about 30%. So we might have paid £2,000 for a 5 kilowatt hour wood burner a few years ago, and now you could pay 1,500 for that. So, if you're willing to put the work in, it could actually be quite economical. And so the kind of things that Toby does to make his a bit more eco-friendly. So he says that looking at the type of wood burner you buy is really important. And actually 1.9 million people apparently still use it. So they are still, relatively popular. Burning wood, he says, is a carbon neutral form of energy. Logs on the fire apparently release a similar amount of carbon dioxide as a tree absorbed when it's growing. It's important to look out for an efficient burner because that'll be more cost effective and it will have less emissions. Or obviously exposure to this kind of stuff over the long term, if it has high emissions, can be sort of harmful to your health. So the burner that he has passed eco design regulations, which means that it burns things efficiently and the air sort of circulated inside, so it burns in a way that heats the home more quickly, and it also has a sealed glass door to stop pollutants getting out. He also makes sure that the stuff that he burns is sort of dry logs. You're not supposed to burn wet logs because they're worse for the environment. Just lots of good little nuggets in here for people who might be looking to do this. So instead of using firelighters as well, Toby says that he heats up orange peel in the oven till it dries, and then you can use that as a firelighter, which I thought was really interesting.
So, they may be going at a discount, but one thing I've found, I have a fireplace and wood is expensive, I've noticed, because it burns a lot. So there's one element, if you are thinking of it, it may be a discount, but actually wood is rather dear, as lovely as it is to, Lee's laughing at me there, as lovely as it is to sit there on a cold winter's evening with the fire roaring. It's expensive. Anyway, Lee, stop your laughing. Give us your tip of the week.
I was going to say, actually, it's a really good point, Georgie. It is expensive.
Thank you.
Ideally, you would have a way of sourcing it for free, but you do have to be really careful about the moisture content, and you can get fined if you are burning wood that is too high moisture content. So you have, as Toby points out here, you have to burn logs with a moisture content of less than 20%, and if you get caught not doing that, the Department for Environment, Food and Rural Affairs can issue a £300 penalty. He owns a £20 handheld log moisture meter where you can check with a short the level of moisture, and it's really important that you do that, not only for your health but potentially for your pocket and for the environment and the planet. And also there's been a massive move in recent years towards these eco-design stoves that are up to 80% more efficient at reducing air pollution than older models, and emit 90% less particles than an open fire. So you have to have all of those things. But if you go to like a good garden centre, quite often there'll be someone that's selling these in a sort of side unit that know all of the rules and regulations, and you're best to go and check out those experts that if you really want to get one, that your home is viable for it and that you're getting a model that is going to be worthwhile getting. And then if you have an old style one that's in your house, making sure that you're getting it serviced and looked at and that it meets current kind of legislations and that it's not damaging your health. Because fire at the end of the day is something that we've obviously used for a very long time to keep us warm. But you do have to be careful. Anyway, my tip of the week. Sorry, I've dawdle on there, but I thought it was important
No,
to throw
Lee,
it out there.
that's why you're here.
But
That's why you're
before,
here.
before people just start burning in the old logs that they find in the woods. My tip of the week is to think about one of the most unloved savings products I think that's out there that actually can be quite a good little home for your cash. And these are what I describe as micro fixes, little tiny kind of, they're not a 1 year fix, but they're not an easy access, but you can get quite good rates on them. So for example, you can get also notice accounts. So notice accounts and these micro fixes, you can get a 120-day notice tracker that currently pays 4.5% to new customers. If you go to Prosper, which is a savings platform, and it's offered by Oak North, there's a boosted 1 year fix there actually from Orion at 4.5%. That's beating everything else that you can currently get out there. And there's also a Santander International 3-month fixed term account in there paying 4.3%. If you go via Prosper and get the boost, best thing to do is come to This Is Money and just search in that little search bar Prosper. And then if you open an account via our website, you'll get those boosted rates. But it can be a really good little sort of halfway house for your cash outside of the usual routes, fixed rates, easy access, cash ISA that I think just comes into everyone's mind. There are little niche savings products out there that might give your money a little boost and well worth investigating.
Thank you. Lee's tip of the week. Right, thank you both. Thank you for listening. You can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions for the team or anything you'd like them to look into, Helen, you look really comfy there, so I just thought I'd ask you.
Oh God, what do we say again, Lee? Do you remember? I can't remember what we say.
You can email us at podcast@thisismoney.co.uk. You can X us at thisismoney. You could also leave a comment on Spotify if you so wish, or you could leave a comment in the podcast article story in which this podcast lives.
Lovely. Thank you very much. And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.